Think back to a time when everyone believed they had mastered the stock market game. The late 1990s felt like pure magic as prices climbed higher almost every single day. People joked you could pick any ticker randomly and still see impressive gains quickly. Old rules about risk and valuation suddenly seemed outdated in this fast-moving market. Every company launching a simple website watched its valuation float into unbelievable territory. Office workers began quitting stable jobs to trade technology shares from their living rooms. Morning TV constantly praised the arrival of a powerful new digital economic era. Nobody wanted to miss what felt like the greatest wealth expansion ever witnessed publicly. It became a golden age where bold ideas were valued more than proven profitable operations. If a startup added a .com name, investors often assigned multi-billion valuations instantly. This period marked the early rise of one of history's most discussed financial bubbles. Understanding why it formed helps protect personal savings from similar emotional market storms. History rarely repeats exactly, yet patterns often echo loudly during modern investment frenzies. Let us explore how the internet first began reshaping daily business and communication worldwide. Before the mid-1990s, most households had never opened or even seen a web page. Then a small company named Netscape released a browser designed for everyday public use. Its stock price famously doubled on the very first trading day during 1995 excitement. That moment acted like a starting gun for thousands of eager new market participants. Investors imagined a future where nearly every purchase would happen online within seconds. They pictured a connected world powered by cables, servers, and near-instant data movement. Money began flooding into any business that mentioned the internet within presentations or filings. Venture capital firms handed millions to founders carrying only early concepts and ambitious visions. Back then, you did not need finished products to secure massive funding rounds quickly. You only needed a catchy brand name and a persuasive story about digital transformation. This environment created a culture focused on spending cash rapidly to capture attention. The dominant strategy became growing as fast as possible and worrying about profits later. Companies burned huge budgets on flashy campaigns simply to build recognizable household brand names. Many firms were not selling meaningful products but selling hope of future market dominance. Quarter after quarter, these businesses reported heavy losses while their share prices kept climbing. Investors ignored red flags because charts moved upward almost every single trading week. Analysts introduced unusual metrics like page views to justify extremely stretched company valuations. Some firms were valued primarily by how many visitors clicked their homepage banners daily. Today, this logic sounds reckless, yet it was widely accepted during the 1999 frenzy. People overlooked that most visitors were not spending real money on those platforms. Hype acted like a powerful drug that clouded judgment across experienced bankers and beginners. Many experts encouraged continued buying even as valuations floated far beyond reasonable expectations. One famous example often discussed is the once popular retailer known as Pets.com. They sold pet food and supplies through a simple online storefront targeting busy owners. Shipping heavy bags of litter across long distances created very high operational expenses. The company reportedly lost money on nearly every order shipped to enthusiastic customers nationwide. Despite weak fundamentals, its shares briefly became favorites among speculative traders chasing momentum. Their memorable sock puppet mascot appeared frequently during expensive national advertising campaigns. Brand recognition soared, yet the underlying business model struggled to produce sustainable profits. There was never a clear path showing how those sales could eventually become profitable. Still, investors kept bidding prices higher because the brand story felt exciting and modern. This situation is a classic warning sign that speculation is replacing careful financial analysis. When narratives matter more than numbers, risk levels quietly rise across the entire market. Another widely cited case involved an ambitious grocery delivery startup called Webvan. The company promised convenient home delivery that would transform weekly shopping routines nationwide. Management spent about $1 billion building automated warehouses before securing steady customers. Their vision required flawless execution alongside endless access to cheap capital from investors. Unfortunately, many households were not ready to order groceries online during that period. Internet speeds were slower and logistics costs remained far too high for efficiency. Webvan collapsed from a multi-billion valuation to bankruptcy within roughly 2 short years. This story highlights how expanding too quickly without demand can become a fatal mistake. Strong businesses need solid foundations before attempting to scale operations across massive territories. Many individuals lost significant savings after placing concentrated bets on these fragile ventures. The broader market reached its peak around March 2000 after an extraordinary rally. The Nasdaq index had surged more than 80% within just one remarkable year. Charts showed near vertical climbs that clearly looked unsustainable to cautious observers. Soon, the Federal Reserve began raising interest rates to cool an overheated economy. Large institutions started questioning whether promised profits would actually appear in future reports. They began selling technology holdings to secure gains that previously existed only on paper. That shift triggered waves of selling, which quickly evolved into widespread market panic. Buyers stepped back, liquidity dried up, and prices started dropping with alarming speed. Companies valued in billions one week were suddenly priced near zero shortly afterward. The dream of an effortless digital prosperity faded under harsh scrutiny from reality. Many assume bubbles form because of only a few dishonest or reckless participants. In truth, they reflect collective psychology that influences nearly everyone watching rising prices. Seeing neighbors profit creates intense social pressure to join before opportunities disappear. This emotional pull is commonly called fear of missing out among investors. People stop asking whether a stock is worth the price being paid. Instead, they focus on selling later to someone willing to pay even more. This behavior is known as the greater fool theory within traditional finance discussions. You purchase overpriced assets, hoping another buyer accepts an even higher valuation later. Eventually, the market runs out of willing buyers and the structure collapses rapidly. Similar cycles have appeared repeatedly across different centuries, industries, and geographic regions. To avoid these traps today, focus attention on real and durable business cash flow. A company must eventually generate more income than it spends to remain viable. Growth is valuable, yet it must lead towards sustainable profits over reasonable timeframes. Look for firms that maintain clear advantages compared with competitors chasing the same customers. Warren Buffett often describes this protective advantage as a wide economic moat. Such moats help defend market share from rivals attempting to copy products or services. If a business can be copied easily, long-term profitability becomes difficult to maintain. Investors should also evaluate the price paid relative to the company's actual earnings power. Even exceptional companies can become poor investments when purchased at extremely inflated valuations. Always compare share prices with revenue growth, margins, and realistic future cash generation. Be cautious when new buzzwords suddenly dominate headlines, podcasts, and enthusiastic conference presentations. During the 1990s, the internet filled that role, promising rapid transformation across industries. Today, different technologies may capture similar excitement and attract speculative capital quickly. When every company claims involvement with a trend, pause and examine details carefully. Some executives adopt trendy language, mainly to capture attention from retail investors. Real innovation usually requires years of testing before producing consistent and meaningful profits. Sustainable success rarely appears overnight, simply because branding or messaging was updated recently. Do independent research instead of following loud voices dominating social media discussions. Read financial statements and understand precisely how each company actually earns revenue. If you cannot explain the business model clearly, consider waiting before investing money. Complex presentations sometimes hide weak fundamentals or declining demand behind impressive terminology. Another important lesson involves diversifying investments across multiple sectors and asset categories. Many people who suffered heavy losses in 2000 held portfolios concentrated almost entirely in technology. Without diversification, they lacked protection when that single sector experienced a severe downturn. Owning shares across healthcare, energy, consumer goods, and infrastructure can reduce overall volatility. This approach ensures one bursting bubble does not destroy long-term financial stability. Wealth typically grows through decades of steady contributions and disciplined allocation decisions. It rarely comes from chasing the latest hot stock promising quick and effortless gains. Those attempting rapid riches often encounter sharp losses when momentum suddenly reverses direction. Patience remains one of the most reliable tools available to thoughtful long-term investors. The dot-com era delivered a difficult but valuable lesson for an entire generation. It proved fundamental economic principles cannot be ignored indefinitely despite exciting technological change. Ultimately, value depends on a company's ability to produce consistent cash for owners. The internet truly transformed commerce, yet many early pioneers failed to survive competition. Amazon was among the few firms that endured and eventually built a durable model. Leadership focused intensely on customer experience while planning pathways toward long-term profitability. Even so, its share price once fell more than 90% during the crash. This shows that even future winners can experience brutal declines when bubbles unwind. Investors therefore need emotional resilience to handle sharp swings without making impulsive decisions. You might wonder how to recognize early signs of a developing bubble today. Watch for prices rising far faster than underlying earnings or realistic growth projections. Notice when numerous young companies rush to launch public offerings within short periods. Pay attention to everyday conversations at gatherings where people discuss easy market money. When confidence becomes universal, caution often provides better protection than blind enthusiasm. Historically, the best buying opportunities appear when fear dominates headlines and sentiment. Conversely, the worst entries usually happen when greed and certainty feel overwhelming everywhere. Following this simple principle can help avoid many severe market drawdowns over time. Keeping some cash available allows purchasing strong businesses when valuations become attractive again. The most valuable takeaway from this history is remaining grounded in practical financial reality. Do not allow excitement around new technology to overpower careful analysis and discipline. Innovation is powerful, yet every enterprise must still operate as a sustainable business. It must deliver genuine value while collecting more revenue than total operating costs. Investors who respect this rule often avoid the most dangerous and overhyped opportunities. Their portfolios tend to grow steadily while stress levels remain lower during volatile periods. The true objective of investing is securing future stability rather than gambling on uncertain trends. Stay patient, stay curious, and commit to learning from past cycles across financial history.